Hey everybody, Economic Ninja here. I hope you're doing great. I have got a lot of news for you today. We are going to be going through it, a ton of news. And let me know what you think of this content format because there's a lot to bring you. I'm going to try and timestamp it so you guys can go straight to the articles that I'm talking about. I am going to explain how all of this is affecting you and is going to affect you in the future. I'm also going to bring up a historical news article that will blow your mind back in 2012. I'm going to show you some graphs with as much, editing as the ninja does. So let's just dive right in because all of this spells collapse. It smells like collapse. It looks like collapse. It is collapse of an economy. And not only our economy, but economies around the world. So let's dive in first. This is out of CNBC. Blackrock says Federal Reserve could hike interest rates to a peak of 6%. Now, we all know that the Federal Reserve, Jerome Powell, is speaking, I think, today in front of Congress. He's being called in front of Congress. Quite frankly, it's all fake. It's kabuki theater. The Federal Reserve is going to keep raising rates. It's going to keep the screws on the economy because it has lost control of inflation. As a matter of fact, I do not believe that 6% Fed funds rate could actually really hold back inflation. We're going to see deflationary downturns as far as the housing market, and we're going to get into that. And as far as other things like the car market, debt markets, right? But I do not believe that 6% Fed funds rate. And please put down in the comments if you agree or disagree. I want to hear your comments. I do not believe a 6% Fed funds rate, to whatever that equates to in the debt markets, is going to be enough to bring down food and energy costs. Okay? We have quite a conundrum here, it's getting very serious with the geopolitical tensions and threats around the world. The supply chain, the global supply chain, is breaking apart. And since we have the on-time delivery system essentially for food these days, nobody lives next door to a farm, right? There's a handful of us living next to farms or have the ability to grow food. But by and large, we are really bound by whatever prices the big conglomerates, people like Bill Gates, that have been buying up farmland at record-breaking pace, set the prices at. All right. So I don't think this federal funds rate of 6% is going to do much except for what it's about to do in the housing sector and in all kinds of businesses around the nation. All right. So let's talk about this story. It says right here, the world's largest asset manager sees the U.S. federal funds rate peaking at 6% after Fed Chair Jerome Powell warned interest rates are likely to head higher than the central bank previously expected. We think there's a reasonable chance the Fed will have to bring the Fed funds rate to 6% and then keep it there for an extended period to slow the economy and get the inflation down near 2%. BlackRock Chief's Investment Officer of Global Fixed Income, Rick Reeder, wrote in a response to Powell's testimony before the Senate Banking Committee on Tuesday. Now, let me explain here. 6% Fed funds rate would bring a average 30-year fixed mortgage into the nines. What do you think that's going to do to the price of real estate and to anybody that's trying to sell real estate right now as they retire and want to move to a cheaper state, or as they want to sell off parts of their real estate portfolio because they see the downturn right now? We're going to get into that with the charts. But what do you think that is going to do? I want to remind you too that, the Federal Reserve, nobody would have thought last year that the Fed was going to bring the Fed funds rate to 5. As a matter of fact, consensus was between 3.5% and 4%. Now, where are we at? See, the thing that people get so shocked about when I used to say, we're going to see mortgages near 20%, we're going to see them there. We're going to go back to a historical mean. It's going to become a meme, quite frankly, because you're going to see something that Paul Volcker was able to get on top of quickly. And I'm going to show you something in the chart that happened to housing prices, where gurus like Dave, I don't remember his name right now, but the debt guru says never happened, right? Housing prices going down. We're going to talk about that, and we're going to talk about how bad it's going to get there. Okay, but keeping inflation around 2%, there's no way. They can lie to you. The government can absolutely lie to you and say, oh, we're at 2%, or oh, we're at 6%. But when you go to the grocery store and you go to fill up your tank of gas, when you pay your natural gas bill, when you pay your electricity bill, you know that we are nowhere near 2%. All right. And that's the thing. There's going to be, like here where they said, and they make it sound real nice. We think that the Fed's going to bring the rate to 6% and then keep it there for an extended period of time to slow the economy. Well, if you've been trying to sell your house in the last year, let me ask you if the real estate market has slowed, or did it stop? We're not talking about the prices. However, San Francisco has already seen a downturn in prices to the tune of 30+% since June. That is a historical record in the amount of time it took to how house prices dropped that fast. But let me show you on a chart, right? This is from Fred, the Federal Housing Finance Agency. Let me show you a historical chart. Right now it's going to be backwards. Sorry, I've got to be able to see if I'm in the actual screen or not. But you can see that this is a chart going all the way back before 1980, is actually in the mid 70s, right? And you can see where we are right here, that little downward little spike. And a lot of people go, Ninja, obviously housing has a long way to fall because that's nothing. That's just a blip. Well, first off, I want to bring out a couple of points. Look at how sharp that drop is right there as compared to what we saw in the downturn of 2005. As a matter of fact, 2005 is directly between these two nice little recession lines right here, right? So right after 2005, when I was like, hey, the housing market's collapsing, we need to get out. And the reason why I saw it in 2005 is because mortgage rates were going up because the Federal Reserve was raising rates from about 2003 to 2005. They were raising rates, and I knew that people weren't getting paid that much more to go out and speculate in the housing market. So I started selling off my houses. And they see this little, like a bell curve, right? Not a plateau, but a bell curve. But once it gets momentum to the downside, it has its equal reaction, right? Now, this spike right here down, that's steep, that's fast, that's sudden. And we're talking about Blackrock talking about literally this slowdown. That's not a slowdown. And I can guarantee you, you're going to have a deeper dip and it's going to be incredible. And you want to be prepared for that. By the way, actually, I'll speak right now. Today is the last day of filming. Thank heavens. I'm going to film the last 2 videos for the real estate course. I'm about to put out an invitation to all of you that bought it for a Zoom. Keep an eye out for that email. In the next couple of weeks, I'm going to do a big Zoom call to get all of your thoughts, what you like about the course, what you didn't like about the course, what I can do to make it better, because I want to make it the best course literally on the internet for real estate and getting ready for this downturn, because this is awesome. That's what you want to see on a chart. Now, let me go back to what happened here in 1982, 83, what people don't realize. Because you remember, like when Dave Ramsey said the other day, or it was in June, he said it last June, real estate has only gone down one time that he knows of in history, and that was for 5 months, a 5-month period in 2008, all right? Now, this Fred chart is entitled the All Transactions House Price Index for California. Now, the reason why I picked California to show you this, and I've got a nation one here too, is because California leads the way in all price appreciation and depreciation across the country. It starts there. It's the most pronounced, right? So in California, you could see that this downturn in housing prices was not a few months, all right? Right here is something very important for you to realize. This is when Paul Volcker spiked rates. He actually spiked rates right before that. And that's what happened to the housing price. You go, Ninja, that's so tiny. Well, you have to realize on a percentage basis, we're talking the difference between a $120,000 home and now a $100,000 home, right? About a 22, 23% drop. Whereas if you look down here, you went from, a little over around 650 down to a base of about 390. So you look at the percentages, you go, you know what? They weren't that far off, right? But you have to remember too, the interest rate gap up here as opposed to here on a percentage basis was much higher. And what you're seeing right now even blows away the gap, the amount of interest rates that went from this rate to this rate on a percentage basis was so much larger right now than what we saw in 2008. And back here, it was even smaller. The average rate on a home was around it it was around between 10 and 12% before Paul Volcker gapped it up, and it peaked at a little over 18. And so on a percentage basis, you look at what they're doing right now, this is much worse. All right, now, this is the all transactions house price index for the United States, okay, from the same agency, all right? Same amount of time. The problem is I've literally, go figure, I left too early and I cut it off. And you're seeing on this side, it's cut off a little bit, but it's starting to dip. Go figure, Ninja screwed it up. But my point being is it's barely starting to dip. Why? Nothing like the California spike, but it's now crested its top, it's plateaued, and it's starting to come down slowly. Well, it's because home prices don't move on a percentage basis as steep and as fast around the country that it does in California. All right. However, it is going to drop, and it is going to blow your mind when you see how much it drops. But again, you saw around the country a stalling of prices in 2008. Well, here's the problem. Or I'm sorry, not 2008, 1980, when Paul Volcker spiked rates, they stalled. All right. The entire country, this is a lot more than a couple of months, a few months, 5 months. Okay. This is actually from 2007, from the peak to the trough of 2012. All right. It's a lot longer than that's national home prices. All right. What I want you to realize too is that this rate of rise this is what's scary and awesome at the same time for you to buy homes during this downturn. The reason why home prices went up across the country so rapidly is because California lost so many residents. We literally lost last year 500,000 people, and we're talking wealthy individuals. If you look at national statistics, the people that left this state forever, and I don't blame them, to go out and speculate on real estate. And I know people personally that took a home, sold a small home, 1,500 square foot, their kids moved out, and instead of like taking the profit and paying cash for a house in another state, they went and put half down on a much bigger house. So they still have a mortgage, right? And then we're going to get into pension funds here pretty soon. This is what's gnarly. This is what's scary. Pension funds start in a little bit. So check this out. We are seeing a story on Zero Hedge. VC funds sees mass extinction event for startups in 2023. It will make the financial crisis look quaint. It says leading venture capital players are predicting a mass extinction event for early and mid-stage startups that will make a global fiscal collapse in 2008 look quaint, or the fiscal collapse look quaint. By comparison, according to Globist, a new survey has found that 81% of early stage startups are facing failure in 2023 because as of the end of October, they had less than 12 months of capital left to keep going because VC funds turned the spigot off last year on a flood of seed funding. Let me grab some coffee. First off, I want to explain that a lot of VCs started to lower the amount that they put in seed funding because of a couple reasons. The cost of money was getting expensive, right? As the federal funds rate goes up, it causes the debt markets to get more expensive, and so they borrow less. Another thing is there are a lot of venture capitalists and hedge fund managers out there that are really smart that have seen 2008 before. It's still fresh in their mind, and they go, "Yeah, we know what happens when interest rates go up." And there are people that run these funds and go, you know what, we're going to pull back just a little bit. We're going to watch this happen, watch the pain happen. And that's what's happening with all these startups. You know, I know young men and women that work in Silicon Valley that are fresh out of college and have stock options and are super excited. And they're just like, the world is our oyster. We're flushing, not cash, stock options, which can be yanked really quick. We're going to talk about that in a second too, as far as your pension fund. And they're about to have the rug completely pulled out from under them. And it will happen so fast. Silicon Valley has a great way of being like a thief in the night. And literally you go to work one day, you leave, everyone's stoked and excited and talking about the growth of their company, wake up the next morning, go to work, and there's literally a chain around the door. And we're going to report on that. It's happening right now in the big places. I mean, you got Amazon, FedEx, UPS, all kinds of companies laying off people in droves, Microsoft. You know, we've been talking about the tech route for a while and how big tech is laying people off like crazy. Think about all these startups. Geez, oh, this coffee. It says right here, an international survey of 450 startup founders in the US and Europe was conducted between August and October of 2022 by research firm January Ventures, with 61% of respondents from the US and 32% from Europe. The founders who participated in the survey were also categorized by the level of funding for the startup. 48% of respondents said they had raised pre-seed funding, 32% had raised seed funding, and 16% hadn't started raising funding. The survey found that 4 out of 5 startups are at risk of failure this year. I said in 2022 that 2023 was a crash. And I said multiple times, I said, if you guys have been following me for a while, you will remember, I said, you're going to see quarter 1 and quarter 2 really prove what happened in quarter 4 of 2022, how bad that churn was. You see, when real estate started to turn in this last June, that was, you remember when Dave Ramsey said housing doesn't go down, you should buy a house, right? I played that video the other day for you guys. When Jim Cramer is out there talking about how you should buy things and these are smoking deals, those are the times you need to pause and go, wait a minute, they were wrong before. I think I know it's coming, right? 2023, like it's saying right here, this group found that 4 out of 5 are destined to fail. They're going to be failing in 2023, especially as the Fed keeps ratcheting up the interest rates. It says right here, an extinction event that extinguishes more than 80% of early stage startups would be the largest since an asteroid in the form of a housing collapse hit the global financial system in 2008. Something else that people don't realize, and you don't really realize it unless you're an entrepreneur and you've been a part of startups and in the past and companies that have rapid growth. In the beginning phases of a company that's experiencing rapid growth, that's when it has the most employees to available work possible, right? Because they're hiring. A company that was a classic for this was Solar City, sort of owned through Elon Musk, but it was his cousins that ran the whole company. They were hiring so fast, so furiously. There was a point where it's like, oh man, we're top heavy, but they had to keep hiring because they couldn't say no to a job. They had to keep putting solar roofs on houses, right? Well, there's only so many roofs on houses. There's so many houses in the state or in the country, and you get saturated. So what do? You start mass layoffs. And every startup goes through this phase, this wind-up phase where it is chaotic and you can't seem to catch your breath. Please let me know in the comments if you've been a part of one of these companies. And what happens is growth starts to level off, or you get your trajectory playing on more of a doable kind of level, right? The angle is not straight up. It's more of a 45-degree angle. And you start to look for cost-saving benefits, especially as these early startup companies go public. When a company goes public, one of the things it's trying to do is cut costs at all by all means possible, because it's trying to look as lean and mean as possible before it hits the street, so it gets the best valuation possible and makes all of the insiders a ton of money because of the share price appreciation. A lot of people don't realize that. So when we're talking about a ton of companies that are destined to fail this year, those companies are employee heavy. All right. Just because they're new doesn't mean they don't have a lot of employees. They're hiring like crazy. They're borrowing money. They're getting their seed rounds going. They're ramping up like crazy. And, that's actually one of the things. I'm part of a startup right now that I have a meeting this weekend. And that's one of the points that we have to weigh very heavily is slowing down on hiring, keeping it very controlled, very easily controlled at this point, because you don't want to have your expenses run away from you and then be forced to lay people off. That's a coffee break. Now, I think that this is very, very important. There's so much when they're talking about an extinction level event. They're not joking, because the amount of debt that's out there is absolutely mind boggling. Now, this from the same article, there's a prediction here I wanted to read. There's a mass extinction event coming for the early and mid-stage companies. Late 2023 and 2024 will make the 2008 financial crisis look quaint for startups. Below, I explain when, why, and how it will start and offer detailed advice to founders on surviving the looming die-off. First, context. Great startups will always get funded, albeit not on 2021 style terms, many good startups will endure down and flat rounds. Merely okay and pre-product market fit startups will die at a greater rate than anything we've seen since 2008. Many startups raised 2 years of cash in 2021 and 22, and they cut burn in 2022 to extend that runway. But no matter what, they need to raise again, sell, or become just dead in 2023 and 2024. Now, a lot of people don't realize this either. You know, when I invest in companies, like right now I'm investing in mining companies, I'm looking for that kill rate, that time where a majority of the companies that were started around the same time, they raise funds for a predetermined set of time. And their goal is to try and get as much, let's say in the mining space, they get as many drill holes drilled, as many press releases out to try and keep the consumer informed, the retail investor, bring the price up so that when they have to raise after that 2 years, hopefully they're raising at a higher valuation. And that is a cycle that we as investors take advantage of. We wait until the companies are hurting because they mismanaged funds, or they mistime the market. And then we come in, we know what's in the ground, and we are investing and negotiating the best prices possible. Um, it's really exciting, and companies, I'll be moving into tech here pretty soon, because the reason why is there's about to be blood in the streets, and that's when I invest, is when there is blood in the streets. All right, now check this out. Central bank gold buying takes up where it left off to start 2023. Now, we have seen all this last year. Central banks were buying gold at record paces, right? They are the smart ones in the room. They're the one that has, we talk about a 20,000 foot overview. They've got the 20,000 foot overview of the world's economy, and they know what's going on better than anybody. That's all they do. They eat, breathe, and sleep geopolitical tensions and risks when it comes to macroeconomics, and they want all of the data. And so central banks have been telling you for a while what you should be doing. Now, this isn't financial advice. I'm not a financial advisor, but I buy gold, I buy platinum, I buy silver. Out of the three, silver is my favorite. But my point being is that I do that because the big boys are doing it, right? It says right here, central banks globally added another net 77 tons to their gold reserves in January. Remember, guys, that is gold that is coming off the street. That is gold that's coming from you selling your gold, the population of the earth selling their gold, and then the central banks scooping it up, having it poured into bar form, whether it's being recycled or, it's getting melted down, or they're buying it from mining operations. They're melting into these massive bars and they're storing it away. You've probably all seen pictures of it. They are taking the wealth, your wealth, the wealth of this world, and they're storing it away for their good purposes, not for yours. All right. It says right here, it was a 192% month on month increase from December, and above the 2060 ton range of reported purchases we've seen over the last 10 consecutive months of net buying. A late report of a 45-ton gold purchase in Singapore by January bumped the numbers up from the initially reported 31 tons. That is a big month over month difference. The Central Bank of Turkey was the biggest buyer in 2022 and continued to add gold to its reserves with another 23-ton purchase in January. Turkey now holds 565 tons of gold. And a lot of people would laugh at Turkey because Turkey is going through a hyperinflation. They have been for quite some time. Well, you want to know why you should not laugh at Turkey? Because they're learning from their mistakes. They have currency problems. And so what are they doing to fix it? They're buying gold. Matter of fact, Turkey, remember I told you a while back, one of the companies I invest with that I've been holding on to, it's one of my long-term holds. They got a call from a Turkish fund and they were like, we want to buy 51% of the company. And it's because they need proven gold in the ground from junior producing companies. They want the best deal possible. Now, they didn't want to pay enough for it, so the deal never went through. But my point being is, Turkey is getting hungry for gold. And before you know it, what country's next? Will it be America? I'm going to be honest with you. I highly doubt that, because pride comes before a fall, and America is probably the proudest of them all. says the country, we're talking about Turkey, has been battling rampant inflation. Price inflation accelerated to a high of 85% last year and was 64% in December. The Turkish lira depreciated by almost 30% last year. Meanwhile, the price of gold in lira terms increased by 40% on an annual basis. Think about that. The Turkish lira depreciated by almost 30% last year. Meanwhile, the price of gold in lira, in Turkish lira terms, increased by 40% on an annual basis. That is why wealthy people and central banks buy gold. That is what happens when inflation runs away. Gold outperforms. It's weird. Someone's been telling you guys this for a long time. And I'm going to be honest with you. This isn't financial advice, like I said, but I would rather hold the gold, the money of kings, God's money, during a biblical event. And that is what I believe you're going to be seeing throughout this whole year of 2023 going into 2024. Remember, before elections, the economies always crater. So it's really interesting. China reported another 14.9 ton increase in its gold reserves on top of the 62 tons reported between November and December. China is crushing it in the gold purchasing area. So is Russia. The theme there is they are going to rival the US dollar with a new reserve currency. I didn't say world reserve currency, but I can guarantee you the world will eventually all be on it because they are slowly moving that way because they're going to back in gold. And that's in my personal opinion. It says here the European Central Bank reported a nearly 2-ton increase. Okay, so China picks up almost 15 tons. Europe picks up 2 tons. That makes sense. The National Bank of Kazakhstan increased its reserves by a modest 3.9 tons. Modest? Kazakhstan, you blew away the European Central Bank by a factor of 2. That is not modest. Sorry to the author of this article, but you just absolutely crushed it. The only prominent seller in January was Uzbekistan with a 12-ton decrease in gold reserves. That's, I guess, Uzbekistan, a lot of dumb countries have done that. Canada sold their gold. How's that working out for them? It's only increased a ton since then. Sorry for the pun about ton. World Gold Council projects the central banks will continue to buy gold through 2023. Well, no duh. But it's not unexpected to expect that the rate of buying won't match the record level of 2022. Well, good news, World Gold Council. You've been wrong before and you're about to be wrong again. Why? Because the world currencies are going to crap in a handbasket. Stand by. I think this coffee's kicking in. Let's do this. Let's mark that time. Coffee kicks in, 27 minutes. Oh, all right, here we go. I'm marking these things down so I can timestamp these for you. All right, here we go. Now, this is very important, right? Because this is going to go into the last parts of these video, and it's about your pension fund, your pension plan. I'm gonna talk about some historical things that happen that most people don't realize, and then literally show you, shake you awake, and why you need to have a second source of income, a side hustle right now. You got to be preparing to get out of debt. Bring nation to standstill. France hit by massive strikes over pension reform. As of Tuesday, a nationwide strike in France caused significant disruptions, such as halted trains, closed ports, empty schools, canceled and delayed flights, uncollected trash, and closed oil refineries. Over 1 million people participating in protests against President Macron. I only say that to insult you because you're a moron. Hey, it's sort of like your name. Proposed to raise the retirement age to 64. The strike is expected to continue through Wednesday. You want to know why he wants to raise it to 64? And this happened in our country too. We've raised retirement plans because it's a Ponzi scheme. And they need to keep more money in the country's stock markets to keep the Ponzi scheme going. Right now, you are butting your head up against the greatest Ponzi scheme in Earth's history, and that is the baby boomers retiring and how much money pension funds swelled, like with money going in over the last few decades of baby boomers going in and dumping money into their pension funds with the hope that it's going to be worth more. I've told the story about my neighbor, how they retired with $1 million in their 401k, and they literally retired in 2007 and were forced to go back to work because they lost 40% of the value of their pension, their 401k, because of the '08 crisis, right? They had to go back. They were business owners, own a construction company, big concrete company, and then they worked at a school as a secretary and a janitor for 10 years. And guess what? They just retired again. And they did it literally a year before COVID. So think about what happened with all of their funds. Hope the school's hiring. They told me I was nuts when I warned them about all this ahead of time. But hope the school's hiring. Unions have called for a nationwide day of strikes for the 6th time this year. Many protest rallies attracted bigger crowds than those organized since mid-January, including Marseille, one of France's biggest cities. This is going to get bigger. It's going to continue to get bigger. But let's figure out how it works over here in our country, okay? All right. This is out of Epoch Times. New rule may weaken millions of Americans' pension funds. And I'm about to tell you some historical perspective here. It says, the Biden administration and Congress are currently caught up in a tug of war over new Labor Department rules regarding whether Americans' retirement savings should be used to finance a climate and social justice agenda. Please put in the comment section what you think about that. If your pension funds should go to an agenda of climate change. You can't make this crap up. It's getting dark and it's getting scary. And if this doesn't wake you up, I don't know what will. It says the conflict goes well beyond and just let me stop there too. If you think for 1 second, oh, it'll never go through. It'll never go through. Yeah, let me tell you about something back in mid-90s. There's something called the Patriot Act. It's going to take a ton of your freedoms away. No, that would never happen. Yeah, well, what happens? They use conflict and tragedy to push a bunch of stuff into bills to take your freedom away. This will go through. I'm telling you, they're going to push this through. The conflict goes well beyond obscure investment rules and administrative procedures and is likely to affect the financial security of many Americans in their retirement years. The controversy heated up last week with the Republican-controlled House approving the measure 216 to 204. Hey, and just so you guys know, I think all of Congress is total crap. I think we need term limits, and that would stop a lot of the buying of people, paying people off. So I don't care if you're Republican or Democrat. I think it's all crap. And I think we need an overhaul of Congress. We need term limits. Wind turbines near Whitewater, California, of course. On February 22nd, 2023, a new government rule allows retirement funds to be invested according to an environmental, social, and governance ESG criteria. You know, those things don't even run all day long. It's absolutely insane. But you gotta wonder, just follow the money. Where are all the Congress people and the government people invest their money? You just follow the money. This crap. This story's gonna just piss me off. It's out of Epoch Times, guys. Go and check it out. It's in. Let me read the title again. New rule may weaken millions of Americans' pension funds. I can't do it. I mean, this is serious. But you know what? This is the good news. If you have a side hustle, you have ways of making money on the side of your job. You're making your own pension plan, and the biggest way to have a great pension plan is to own your house. Own your house. That is the most insanely easy thing that anyone could do right now. Just own a home. Pay off your home. Stop borrowing against it. Stop buying crap with the money. Pay it off, and then when you have it paid off, you can enjoy that not needing that much more money in your pension. Think about that. Okay, now this is a historical document. This is a news article that was out of 2012. And I've told people this, and this is why you need to be prepared for the worst and hope for the best, all right? And it's entitled, I'm writing down my time because the Ninja's super fancy, 5 big companies that have cut out pension plans. Now, this was written in the depths, June 22nd of 2012. This is in the depths of the Great Recession, all right? We were just coming out of it. Over the years, giant corporations have been relying less and less on traditional pension plans. Lifetime employment and healthy retirement payout used to be the accepted norms in business in the United States, but these have slowly given way to the elimination of the defined benefit plans and to jobs that only last that last only a few years. The emphasis these days is on defined contribution plans. So it's the difference between DB and DC plans, defined benefits, defined contributions. And it saved companies a ton of money. Let's talk about this. General Motors. Most recently, auto giant General Motors announced it would be cutting about a quarter of its pension plan. The move will actually shift roughly 26 billion of its 109 billion pension liability to insurer Prudential. The transaction has made a big dent in its pension obligations and a shift much to the future, a risk to the party that should be more adept to managing it. So that doesn't even make sense to me. But my point being is that General Motors saved a ton of money by getting away from defined contributions. So they made the shift. The government, the US government made a shift back in what? Oh gosh, I want to say it was like 1998, doing the exact same thing. American Airlines, a trip through bankruptcy court usually serves as an opportunity for a company to adjust its pension obligations. Airline giant American Airlines recently declared bankruptcy. This was during the financial crash. Remember, people weren't flying anywhere, they didn't have the money. And had discussed cutting down its pension promises it had made to roughly 130,000 employees. A recent report estimated that American only had 45% of the 18.5 billion in pension liabilities on its books. The report suggested that some pilots could lose their current plans, while there is almost certainly to be major cutbacks or even an elimination of the pension plan for current or future employees. Let me finish it right there where this story drops off. They won. American Airlines took their pension plans. Gone. And the Supreme Court allowed it. And if you're an airline pilot that was working during those times, please put in the comment section, back me up, because it wasn't just American. Once American did it, all these other airlines, I believe Delta was part of it, and there's United was part of it, they jumped on and said, hey, we're screwed too. You see, what happened was all the money in their pension fund that was going to pay people, they were, risking in the stock market. And when the stock market downturned, they didn't have the money. And that's what's about to happen again the next few years in America. AT&T. Last fall, the Wall Street Journal published an article detailing how many companies have been steadily cutting back on pension benefits for current and retired workers. It cited as an example where a retired employee estimated his benefits were cut back to $18,000 annually, down from $50,000, and due to a freezing or reduction in benefits. It also mentioned the ability for companies to offer lump sum payouts, which can eliminate future liabilities and has likely been utilized by large telecom players too. Verizon, back in 2005, telecom giant Verizon announced a freeze in its traditional pension plan and a shift to emphasizing its 401k plan. Again, much cheaper for the company. In the announcement, the company cited the fact that many competitors were doing the same thing. So, to stay competitive, it had to start shifting from the traditional retirement plans to ones where workers share more of the burden of having to save for the golden years. Now, a little tidbit on that. When the government switched from CSRS or CSRS, you guys will have to remind me, back in the late 90s, to FERS. That was that transition from defined benefits to defined contribution. They scammed government employees just like Verizon did. Like, hey, other companies are doing, we need to stay competitive. And people are, yeah. And once you switched from CSRS to FERS, you could never switch back. And a lot of people that had no financial comprehension, and I worked with these guys, they switched over, and now I got hired. It was already FERS, right? I was too late. But they got hired, and they were sitting there going, what did we do? And they were screwed for life. It just blows my mind. And that is about to happen again. It says right here, the bottom line, during the credit crisis, and just, the credit crisis they're talking about back in 2007, 2008, it's going to be bigger this time. We're in one way bigger. Big companies even stopped providing matches or lowered them significantly on the new defined contribution plans. Saving for retirement is increasingly the responsibility of the individual workers, and that is unlikely to change going forward. Think about this, guys. This is going to be much bigger, which means there's more opportunities. But I'll tell you what, you need to protect yourself right now. Start looking at paying off debt. One suggestion, and this is the nugget for the end of the video. I was talking to somebody one day, and I said, I can't give any financial advice. And they were asking me for financial advice. What do I do? And I said, well, how much do you put in your pension plan? And they told me the percentage. And I said, how much debt you got? And they told me, and I lined it all up. And I go, do you think you're going to see a stock market crash in the next few years? The downturn like we saw in 2001, 2008, 1994, 1987, early 80s, you know, the ones that come just about every single 7 to 10 years, you can hit them on the clock. And he said, yeah, I do. I said, then you have to ask yourself a question. Why are you buying shares of the stock market at high prices when you could just stop putting all your money into your pension fund, keep that money there, and then just go put it down to paying off your house? And then look at how much you've got. I mean, how much would your pension fund have to go up? How much is your, I asked him, how much is your mortgage? He goes, 2,000 a month. I said, well, how much do you need to put in your pension fund for your fund to start paying out, let's say at an annual rate of 3.5%, you know, to make $2,000 a month? And he started to do the math and his eyes just got big. He goes, oh my gosh, I could pay off my house. I'm like, why don't you do that? Because then you have a bird in the hand, which is better than two in the bush. Guys, I hope you got something from this. Let me know how you like this format. And thank you to everybody that hit the subscribe button and the thumbs up. Really appreciate it. And just remember, guys, that last 2 course lessons for the real estate crash course is coming out. They should be edited and done by next week, but I'm filming them right after I get home today. Hope you have a great day. The Economic Ninja is out.